Hi everyone, thanks for joining the webinar today. This is a bit of a session over asset finance is the theme for today. And a couple of weeks ago, the base rate held itself at 5.25. So it's a lot different, and the costs are a bit higher than what a lot of SMEs are used to. So one of the ways we're looking to combat that, or firms looking to combat that, is exploring things like asset finance and using assets within the business to achieve hopefully better rates. But I thought it would also be a good opportunity to go through asset finance as a bit of a overall from one of our specialists here to give you a bit of insight on the different types and the different use cases for this product. My name is Marcus, and I'm part of the success team here at Swoop. So I help advisors implement all the different products we have here in the suite of Swoop, ranging from loans, grants, equity, and savings. And so I have Tom.
Afternoon.
Listen, do you want to introduce yourself, Tom, in terms of what you do in the business?
Yeah, so my role within Swoop is part of the asset finance team. I've been with Swoop for about 2 years now. Been in the industry for about 7. And my role effectively as a funding manager is just ensuring that all the customers that we see from an asset finance perspective are put with the suitable facility and done so as quickly and efficiently as possible.
Excellent. Good stuff. Thank you for that. Well, we'll cover a few questions on the call today, and it's a bit of a bite-sized session to go through sort of what asset finance is and some use cases and some of what we're seeing from lenders. But I think a good place for us to start really is lending is a bit of a different market really at the minute, particularly unsecured, and we're seeing rates a little bit higher, and lenders probably being a little bit more picky with who they want to lend to. But from an asset finance perspective, what's the appetite you're seeing from asset finance lenders, Tom?
Well, appetite's good. Despite the goings on in recent years, the market has never really retracted from an appetite perspective. Maybe post Seaballs, when lenders had hit their sort of quotas through the Seaballs lending alone, they could afford to be a little bit more fussy over who they lended to, but there's never really been a distinct lack of appetite. Businesses at the end of the day, they're always going to need funding. If the customer and the asset is right, then there's always going to be an appetite to lend to them.
Yeah, makes sense. In terms of rates, I know that the base rate's gone up quite a lot, and I think people have pulled back a little bit from borrowing. During COVID, people would sort of like borrow first and then look for something to do, like borrow for like a just in case type approach. Appreciate the mindset shifted a little bit now, but what sort of rates are you seeing for assets? Again, depends on the asset, but from your perspective.
Well, fundamentally, the thing to note is that the pattern we are seeing is that rates are reducing across the market. Rates themselves at the moment, I'd say they were starting from around about 4.5% for hard assets, about 7% for soft assets. But again, of course, it does always depend on the customer and the asset itself.
Makes sense.
I mean, it's worth noting we had a rate signed off just last week for a particular facility, which was at 3.7% flat, which sort of pre-inflation was the norm. And it would be nice to see these rates becoming more commonplace again as the base rate sort of continues to hold itself and then potentially starts falling over the coming quarters as well.
Yeah, it makes sense. It's a good indication the rates are falling. I imagine that's just probably a bit of an indication of how comfortable lenders are getting with the market. I know that they all kind of bounced their rates up quite heavily once the base rate went up, probably a little bit too much, and they're now getting more comfortable with how businesses are performing and adjusting their rates to be competitive, but also reflective of their confidence in the market. So that's all quite positive. You mentioned there about sort of hard assets and soft assets. Do you want to give a little bit of rundown for those that aren't fully up to speed with sort of what type of assets sit in each of those?
Yeah, so generally speaking, a hard asset is something that has a tangible value in it. A general rule of thumb to think with a hard asset is something with a serial number that's individually identifiable, something that's going to retain its value throughout the length, and something that is easily recoverable from a lender's perspective if and when that scenario was required. Your soft asset tends to be stuff that is more intangible, that might not necessarily identify itself through a serial number or a registration number. Things like your software, your scaffolding, your fit out, your furnishings, your fittings. those in themselves, from a lending perspective, gives slightly less security naturally. With them having less of an opportunity to potentially repossess any equipment and therefore subsequently take the money back. And the general feeling is that the lower the risk, the lower the rate.
Yeah, that makes sense. Okay. And naturally, obviously, you mentioned recoverability is quite key there. Again, the easier it is for the lender to get their money back, typically the less risk, and I suppose the more competitive they can be. So that makes sense.
Yeah.
Now, I think a lot of people will hear asset finance and immediately think, "Oh, I know that hire purchase. I put my car on hire purchase," and we'll take some similarity with that. But I'm conscious that there are a few different types of asset finance out there, depending on what the client's up to. Do you mind sort of giving a bit of a high level overview of what that looks like, and I suppose what problems they solve for a business?
Yeah, well, hire purchase is the most common form of asset finance due to it being, the cleanest, the simplest, and generally the most cost effective. Other common forms, though, are finance leases, which is where we can offer incentivized end of lease terms, and of course, your sale and HP and leaseback facilities too, for when the assets themselves have already been bought. They're all suited to businesses across the board, though. There's no particular asset, no particular facility set for particular businesses. It does depend on the asset itself and what the customer is looking to achieve.
Okay, that's good to know. Because there's quite variations to it. I know that some people will either default just to a hire purchase or just to a traditional lease, without knowing the benefits of each of those, and the fact that I suppose you can structure them in certain ways to have a bullet at the end and other bits that might work better for a business. Okay.
Yeah.
On that point, I mean, we see a lot of businesses default to the traditional lease. So in the concept that they don't ever own the asset, they just pay a kind of like a rental, I suppose, on the asset itself. What is I suppose, the negatives of that? Again, I think the reason they do it is because of ease, perhaps, but what is the benefit of other options, and what could be some of the drawbacks from a traditional lease?
Well, I mean, look, leasing itself has its pros and its cons. At Swoop, we offer finance leases, but that is a totally separate product to what people tend to take on vehicles, which is the most common form, which is more of a contract hire type facility. I mean, look, the obvious negative to it is that it costs the customer over the term, and they'll never take ownership of the equipment. You know, the one thing I'd always say as well is never jump into a lease without considering the other options, without looking at it from a bigger picture perspective. If we are comparing hire purchase, whether that be with a balloon or fully amortizing, in contrast to a contract hire style lease, then we are comparing apples with oranges. And there's never necessarily a like for like alternative, but it's always worth noting that with the hire purchase options and the ownership route options, an additional £100 a month, for example, on the rentals could end up saving thousands overall. And that's without considering the accounting and balance sheet and ownership benefits, things like, reducing the corporation tax of the business as it is an acquisition of an asset, the asset sitting on the balance sheet and increasing the net assets position, etc. It's not taking those into consideration. It's more, it has its obvious benefits through the equity stance in the asset itself as well.
Yeah, that makes sense. Okay. So we talked a lot about sort of buying new assets in the business, and that's definitely one way you can use asset finance. I'm conscious of saying that we've seen a lot of more recently is those businesses that are using, I suppose, the assets within the business they currently have that's got a little bit of equity with it, in order to, I suppose, comfort the lender a little bit more to be able to achieve better rates. What are you seeing in that sort of asset refinance kind of space, Tom?
Well, the most important thing to know is that where a business does have the luxury of having these assets that are on the balance sheet and they are sat with equity in them, refinancing them is so long as the assets themselves are suitable for refinance. A refinance is always going to be a more cost-effective alternative than your unsecured loan.
Yeah, that makes sense.
Mainly,
Okay.
mainly because of the security through the asset. if there's the opportunity to use that, what we would always say is, let's have a look at the assets that are there. Let's see what the assets are valued at, and let's see what we can leverage against them. It's not necessarily always the divine solution that is always right, but it's certainly worth considering, especially if we're looking at things from a cost perspective.
Yeah, that makes sense. I think, like you say, I think there's so many variables with it, but I think it just makes up part of that, I suppose, holistic view of how we can bring cash into the business. There's various ways we can do it, whether it be through the debtor book or through the actual hard asset itself, or maybe it's even looking at traditional unsecured borrowing. It's really about trying to get them to their preferred outcome as opposed to where the funds are necessarily from. I think we can combat some of those rates increases as well by giving the asset to as a piece of security to the lender. Then that's a win in itself.
Yeah.
In terms of the rates, in diving a little bit deeper into the rates specifically, what you mentioned, one of the rates you had earlier for asset purchasing, for asset refinance, how would that probably compare to a traditional unsecured loan? If it's because in this scenario that the client just wants, say, 50k or something like that, whether we take it out an asset or take it out of unsecured, the biggest differing, I suppose, is going to be the cost. What does that look like?
Well, the first thing to note is that his refinance is pretty much always against hard assets.
Yep.
So the lenders will always have that security in doing the refinance. If they don't have the security, they won't do the refinance. That in itself, of course, subsequently reduces the risk and therefore the rate, as we've already touched on. Asset finance itself against hard assets is cheaper than loans. In the vast majority of cases. I mean, there are anomalies, of course, but as a general rule of thumb, it's always worth considering that the asset finance is going to be cheaper than a loan, especially against hard assets. So when there is the equity there, like we say, it's worth considering. In terms of the actual rates, again, it depends on the structure of the deal. If we were to use an example, and it's the one that I do touch on the case study that we use quite regularly, but when there's equity to be taken out of assets, even if the assets aren't unencumbered, we can settle off existing finance facilities with the refinance. So again, just to come to the case study that we use, there's a particular example that always springs to mind where the gross loan amount was about £130,000. We put it through a tier one lender. The credit was good. The assets were hard. It was 8 vans. In settling off those outstanding finance facilities, which I think from memory was against about 5 of the 8 vans. The gross lend amount was 132, and the client had a desire to net 50,000 at the end of the process. In netting them 50,000 through lending 132 as a gross loan amount and settling off their existing finance, the repayments over a 5-year term monthly and therefore overall were less than a £50,000 offer that we had from an unsecured loan provider. Now, of course, it's always worth considering that the unsecured loans, they do have their purpose, they do have their uses. It just, in these particular instances, it's always worth considering, if rate is the driving factor, any assets that can be refinanced are worth looking at and worth considering.
Yeah, absolutely. And I think that in that case, like say, even if you kept the rates the same, that would have been a win. But if the fact you're able to trim off some of those monthly repayments by adjusting the term length or even bringing some of the costs down, is a win-win. And there's probably lots of clients out there that over COVID had either purchased kit with that cash and now it's sitting there unencumbered on the balance sheet, or as you say, might have a mixture of different types of asset, of different types of agreements with all different lenders, and sometimes just tidying that up, put it under one lender and being able to release some of the equity from that could be a way for them to get to the same outcome, potentially with better terms as well, which is always good. Okay. So the next bit I'll dive into is around sort of how, just a bit of run through of sort of how the firms might want to approach some of that conversation. But before we do that, if you had sort of one tip for our advisor partners when it is whether it be spotting an opportunity to have this type of conversation or spotting the right type of client for this, what would you say would be the best way of either positioning it or using this stuff to reach out to your clients?
I think the best way to use Swoop is to do exactly that, and it is to fully utilize us and our services.
Mm.
What I mean by that is, we don't expect our partners to be the experts. That's what myself and the rest of the asset finance team are here for. But I would always say to the accounting partners and the advisory partners to get in touch with us, to use us, to speak to us, whether it just be for an initial quote, whether it just be to see if we can spot a particular opportunity on a particular case that may be coming up. Of course, the asset finance product in itself, it does speak for itself. It does sell itself. In that if a customer's buying a piece of equipment and they haven't necessarily got the cash funds available to do so, the asset finance is the sort of almost a no-brainer solution to that.
Yeah.
But if it is just, well, can we get an initial quote to see what we can do? If it is just a case of, well, they are looking to reduce tax liability, so what can they purchase? What's business critical? What can we do from that perspective? Again, we're always on the other end of the phone, and I'd always encourage people just to pick up the phone, speak to us, get an idea of rates, get an idea of what can be leveraged against what assets, and we can then identify what a potential solution could be from there.
Yeah, that makes sense. I think one of the best things about us here is it's probably the breadth of options that we have. And I think, like you say, I think it's not just about, oh, this client wants a loan, but it's about lifting it a bit further and let's find all the ways that we can bring cash into this business, whether it be through refinancing assets or grants or loans or whatever it might be. Because clients will have a way they've done it before. They might have a particular bank that they go to or a particular lender. There's over 300 lenders across the UK for commercial lending in various forms. And having one lender with one lending policy is going to restrict, I suppose, the opportunities that you've got for that. So the benefit of us here at Swoop is that we've got such breadth.
Yeah, I mean, look, it's natural for a client to revert to their bank. I mean,
Mm.
If they don't have an existing broker relationship, the obvious thing to do, well, there's two obvious options. There's approach your bank. Nowadays, we know that the bank manager is really non-existent, which means the second conversation then comes with the next person they trust from a monetary perspective, and that is the advisor, the accountant. Yeah. These conversations, as bank managers become a thing of the past, these conversations will become more and more. But one thing we would say is, if we can avoid placing things with someone's bank, then there are benefits of doing that. Of course, there are other lenders out there that can be as cost effective as people's own banks. But what that then does is it does spread their exposure from a risk perspective. So they haven't got all their eggs in one basket. And in the long run, that can prove fortuitous to some clients when we look at things from a bigger picture, and if they ever do need to rely on the bank for other facilities further down the line.
Yeah, that makes sense. Okay, excellent. Well, it's a bit of a summary. I think really what we're getting here is that one thing I push quite a lot with our advisors is you're never really going to catch the client just at the right time, just before they buy that new bit of kit or just before they want to raise some capital for the business. So I think a lot of this is around about how frequently we are speaking to clients about it. A good time of the year to do it is naturally going to be at year end, when there's a bit of a broader conversation about what your plans are for next year. One of the tips I'd probably share is, if you see there's any new assets when you're doing the asset register or reconciling bits for year end, is just to ask the client why they haven't come through you, and just to remind them that you can provide these other services, funding, whatever it might be, through your partnership with Swoop. In addition to that, I think building it into the processes through your onboarding or proposing to your new clients, to remind them right from the outset of a brand new business that you can help with raising funding. You're going to know whether they're a regular borrower or not, whether they've got overdrafts or credit cards or they've got assets in the business. So identifying that client as a regular borrower is quite key right from the outset, to make sure that you are reminding them all the services that are going to be suitable and valuable to them. So definitely consider Swoop where possible, and give your success manager a quick call, because there's a range of ways that we can help, whether it be through blog content, whether it be through education for the team in how to spot these opportunities, or whether it would just be general content you can share in your client meetings as well. The other bits I wanted just to touch on as well is that we can support with client reviews as well. So if you were having upcoming client meetings and you wanted just to walk through, say, 5 to 10 clients that you're going to be speaking to soon ahead of those calls, so you are a bit comfortable and a bit more prepared to open up those conversations, lean on us where possible, and we can highlight some areas that are worth touching on, whether it is asset refinance or purchasing new assets, depending on what industry they're in, or whether it be other ways that we can help here at Swoop. That's all we got for today. Thank you, Tom, for your help with this and answering some questions there. I'm sure that the guys will be in touch if they do have any questions. My name is Marcus. We've had Tom here today from the asset team, and we look forward to seeing you soon.